Perfect. Should be just about there.
The Name Confidential Live.
Perfect. Thanks. Hey, good to have a good happy Friday, everybody. Already tongue-tied. It's been a long week in the market, so it's been a little crazy. This is episode 10 of season 2 for Name Confidential. I'm this week's host, Ryan Redfern. Today I have the super cool and awesome Jim Lee, one of my favorite people, financial futurist, just an interesting, little bit out there guy, but I love his work and his what he does. So we talked last year. I'm glad to have you back on today, and we're going to talk a bit about cycles, seasonality, and some other fun things along the way, and what's working and what's not. You had some great insights there on your newsletter, so I wanted to definitely talk about those today as well. But as usual, let's kick it off with the Name Sentiment Index. Let me grab that real quick to share, and that should be sharing. So current sentiment sentiment index is currently at 74.96. That's actually kind of low, but not that low, not low enough to really be concerned, which is interesting because in contrast, the AAII Bear Index was way down. I know personally, I reported 80 this week, so I was right in there with the rest of them, but still mostly invested. So let's go to Jim. I know you're not a contributor, but any insights from the NAIM Exposure Index this week?
Yeah, just kind of looking at this, I'm hearing that a lot of individual investors have been cashing out pretty seriously over the last week or two. So this is actually a little bit more optimistic than I would have expected it to. My understanding of the NAIM index is that you want to look for extreme oversold levels, above 100 being overly bullish, below, let's call it 65-ish is, back up the truck and start loading up on shares. I don't think we're there yet. Do you?
No, I don't think we are. And that's one of the factors. I know certainly what I look at really didn't look much more than a regular routine 5 to 6% pullback in the markets. And that may be how it plays out. I know now in the bigger picture, I think we're coming into something much worse. And I think you've got some awesome charts that are going to lead us there. But yeah, I don't think we're quite there yet.
Yeah, not yet. What was that paper that NAIM did a year or two ago? Was it the 10% canary or the 12% canary?
Oh, it's actually the 5% canary.
It was the 5% canary.
Yes.
Can you talk about that a little bit?
I don't know much about it. If you want to dive in, you certainly may.
Yeah, basically it says that if you have a 5% drawdown within the context of, I think, about 12 trading days, right? Then it means that there's more to come, right? Because that initial deceleration going down is happening fast enough to create some momentum. And we have had about a 5% pull down in the last 2 months. I need to see if we've had that in the last 2 weeks or not.
Right.
But I know the NASDAQ's heading into correction territory at this point. We're putting together a whole wish list of stocks that are now off like 40% in the last 2 months.
Oh, wow.
So there are segments of the market that are just getting killed right now.
Yep.
If you look at market internals, right?
Oh, for sure. And the Mag 7, which were so amazing last year, are all looking real ugly this year.
Yeah. But you look at the blue chip stuff, the equity income types of things, healthcare stocks, even those are positive this year, sort of in the 2% range, really nothing too bad. But
absolutely. But it's the defensives that are winning, not the
defensives are winning. And that says something, right? When the defenses are winning, then something's, broken or not working. So, yeah.
Absolutely. So your newsletter you put out, I'm certainly a reader of it, longtime reader of it, and I thought you talked about some neat cycles that I hadn't been looked at in a while, specifically the kitchen and I don't remember the other name of the cycle, but and how those work together. So do you mind diving into a little bit of what?
Yeah.
I know you're a studier of cycles as well, and there's a whole society of that so.
There is. Yeah. The secret society of cycles technicians. Right. And, I actually got into cycles through my dad, who's a scientist, right? And he had a gadget in his workshop called an oscilloscope. And what I learned when I was like 7 years old or whatever is that you could convert any form of energy pretty much into a cycle, whether it's electricity, whether it's sound, whether it's light, even gravity is a cycle. And you would talk into a microphone in this machine, and then your voice waves would go all up and down the screen. And it just seemed kind of like magic for me.
Mhm.
And the louder you talked, the bigger the waves were, right? And the question that came to my mind was, could you convert sort of social energy or social energy into a wave, social move, and then see, when it's going to go up and when it's going to go down, and maybe be able to anticipate in advance some of those turning points. Okay. So I believe that there are trends within cycles and cycles within trends. And the magic of cycles is they tell you when trends bend and
Mhm.
when they end,
Nice.
right?
Yep.
So they're very good at timing.
Mhm.
I do run some market timing algorithms for both individual clients and also for some institutions. And that model really has three kind of broad components to it. We have seasonality factors,
Right.
right? We have calendrical factors, sort of day of month effects.
Mhm.
And then we have some of these longer term cyclical factors as well.
Mhm.
And we've applied machine learning to our algorithms to see which factors have been working, which ones have been bad, who's been naughty, who's been nice.
Right.
And the seasonality factors kind of went off the rails about
Mhm.
3 years ago, right? And
Yeah.
and they're coming back now. But
Yeah.
for 3 years, they really weren't working well at all.
Yep.
And we were having some issues with some of the calendrical factors too.
Mhm.
And I think honestly, some of that was the result of the Federal Reserve just kind of messing around with interest rates,
Right.
pushing them up and pushing them down. But the longer term cycles that we follow were aces. They were just amazing. And so we've promoted the weightings of those
Mhm.
cycles in our scorecard, and they have a bigger influence now on our market calls.
Nice. Nice. And you were
So,
saying
mhm.
one of those was the kitchen cycle, right?
Yeah,
From your newsletter. Do you mind
yeah,
talking about that a little bit? I think that's just a really
sure.
neat concept. And I did my own digging, but I wanted to talk to you about that as well while we're here.
Yeah, yeah, yeah. So kitchen cycles showed up in my freshman economics textbook as a type of business inventory cycle. And I'm going to use an example here from COVID, which is the bicycle industry. Okay. And when COVID hit, everyone went stir crazy and they wanted to go outside and bicycle because there was really nothing else to do. Um, and as a result, bicycle stores were sold out months in advance. And they would order more and more bicycles for their inventory, knowing that only a small fraction of that order would get filled. So they ordered 2 to 3 times more bicycles than they knew that they could sell. But when COVID stopped, people started socializing and mingling a little bit more. There was a bubble in bicycle prices that peaked right around 2022. And then all of the bicycles started coming in. Companies had more bikes than they had cash. So they had to do bicycles on fire sales, right? And
Yep.
that's a great example of how inventory cycles can affect business profitability, right? By people getting overly enthusiastic and
Right.
then overly, depressed later on.
Mhm.
So I use some tools. I'm going to go into screen share mode
Oh,
here.
absolutely. Yeah, please do.
Yeah, yeah. I use some tools from a group called the Foundation for the Study of Cycles, or the
There it is.
FSC.
There's the secret society.
That's the one, right?
Yep.
And I did a 25-year back test on the S&P 500, which we have in dark blue here at the bottom. That's the S&P 500. That's a weekly chart, by the way. And then I ran something called a spectral analysis, which looks at all of the possible cycles running from roughly 3 weeks to 350, 400 weeks in duration. And then I ranked all of those cycles based on three things. One, the total height of the cycle, which is called amplitude, the strength of the cycle, which is how many units the market goes up when the cycle's going up and how many units per day the cycles go down when the market's going down. And then something called the Bartell's ratio, which is a little proprietary to the FSC, but it's really a measurement of fit for cycles. And when we run a sort here based on the best fit to the worst fit, uh, the very best cycle here is a 350-week cycle, which is called the jugular cycle,
Oh,
right?
yes, here it is. There's the other
That's the
cycle.
other one.
Yep.
That's the capital investment cycle. It's been around for a long, long time. And that still is influential. It's still, a good fit. I'm going to pull up what that chart looks like in a moment here. And you can see the jugular cycle did a pretty nice job catching this rise. It was a little bit earlier out than the S&P on this 2022 sell-off, but yeah, it did go down and it got very bullish right around what, May of 2023, and it continues to be bullish right now. Okay. And this is a longer term cycle. It typically runs, you know, 7 or 8 years thereabouts in terms of duration, and it's still in play. But if you look at the cycle, it's actually not the strongest cycle. It's one of the better fitting cycles, but on a day-to-day basis, it's not the strongest kid on the block here. That actually belongs to what's called the kitchen cycle, again, or the inventory cycle, which is, what I referenced with the bicycle story. Okay. So this lasts 181 days or 181 weeks, about 3.5 years or thereabouts. And this cycle has a great track record over the course of the last 25 years. It, pretty much nailed the stock market peak at the end of 2000. We then had a market trough, which it anticipated a little bit 6 months earlier on that side. Subsequent rebound. It caught the financial crisis very nicely right here. Subsequent rebound from that. We had kind of a false sell signal right here. No cycle is perfect, but this one's, again, pretty good. A more valid sell signal right here, and then a really, really good sell signal in October of 2021, right? So some fun history about the kitchen cycle. It was discovered by a Russian economist in the 1920s, Joseph Kitchen. And you can look this up on Wikipedia. And he, his research indicated that this was one of the most influential business cycles going back over the last 50 years. So we have, at this point, about 150 years worth of history on this cycle. And it's arguably still the most important cycle of all in tracking the S&P 500, right? So this is a big, big deal.
Oh, that's amazing. Yeah.
And I do a few little things in the cycle just to make it a little bit better. One is that you'll see that the tops and the bottoms are not evenly spaced. If you really want to nerd out with cycles, you add what's called skew. So that cycles spend a little bit more time going up than they go down. Because we all know as investment guys, the market goes up slowly and it goes down in a hurry, right? And it's when it goes down, that's when you want to get out of the way, okay? So I did that to the mix, and then I did an overlay over the S&P 500, and I've been bullish. I've been seriously bullish for the last year and a half. It's been fabulous, made a lot of money for folks. But here we are. Last week, it put together the first sell signal in about 3.5 years. And this isn't a signal telling me to get out of everything, for the next 15 months, but it is a good signal to dial down risk exposure. And what I've been doing is I've been reducing my exposure in client portfolios by like 10 or 15%.
Mm.
Okay. And adding some fixed income exposure, a little bit of precious metals exposure, certainly adding some cash exposure. I have been taking profits on some of my aggressive growth stocks beginning last December.
Oh, nice.
So my aggressive growth stock portfolio is about 20% cash right now, which is pretty defensive, for a growth tech, portfolio.
Yeah,
And I'm beginning to move from, truly aggressive growth now to something a little bit more GARPy or growth at a reasonable price.
sure.
So I knew this was coming last summer, right? Like, the nice thing about cycles is they give you a lot of
Yep.
warning in advance. And I was able to have a lot of conversations before, this week even started, because I kind of knew where I was going with this. And that just makes it a great tool.
Mhm.
You're not waiting for things to happen to get a signal from your cycles. Months, sometimes years in advance when these things are going to start rolling over. And what this also says is that, the cycle says, it could be kind of tough sledding till kind of mid 2026.
Mhm.
Okay. Now, something else you need to know about cycles is that you can stack them together
Mhm.
and they form something called harmonics, right? So
Yep.
just like those Russian dolls, they kind of nest within each other. You can do that within cycles, and they tend to occur at even intervals of each other. So we talked about the juggler cycle being 350 weeks long, which is roughly twice the duration of the kitchen cycle of 180 weeks long.
Right.
And you can see that they interact with an effect that every other downturn of the kitchen cycle tends to be bigger. Okay. So the downturn that we have coming up right now within the kitchen cycle isn't quite as bad as the one that was forecast at the end of 2021. And the suggestion to me is that, yeah, maybe the market takes a break, maybe there's a little bit of pullback. I don't think the wagons are going to come off the wheel, at least immediately. I mean, I've been fielding a lot of phone calls from clients who are concerned about, tariffs and things that they hear about the news. But I don't think we're going to have another, 20% year for stocks. I think that's fair to say, right?
Yeah. Yeah.
And probably a good time to take profits.
Sure.
Um, the other cycle that I use, just kind of, complete, the trifecta here,
Uh-huh.
is I also use a 24-week cycle as well, which is a little bit stronger than this 34-week cycle, just as good in terms of fit. And when you combine these three cycles together, what this says is that this peak might not happen until like May of this year
Uh-huh.
versus last week. So I think we have kind of this window
Mhm.
running from the end of February to kind of middle end of May where stocks really could roll over,
Yeah.
right? And then at that point, you start looking at your trend following systems to see
Mhm.
if you're getting confirmation signals from those two.
Absolutely. What I love about this is that I don't do cycles the same way you do, but I do look at them, that and seasonality. I
Mm-hmm.
like the real estate cycle, which is puts, supposed to peak out around 26, just almost in concert with what's going on here. I'm
Mm.
looking at that same time frame, looking for the same pullback, maybe something bigger than what your stuff is showing. But for the most part, the same time frame, I'm looking at it going, yeah, this should be a rough period. And I
That's
came at
cool.
it a completely different way, but my stuff agrees.
Oh, that's cool. Yeah, thanks for mentioning the real estate cycle. That's typically like an 18 to 20 year,
Yes.
sometimes it's called a metonic cycle.
Hmm.
I have a book recommendation for you, by the
Love
way,
it.
on the real estate cycles. This is fun. This is fun to read. The Secret Wealth
Oh,
Advantage.
yes. Okay. Yeah.
Really well written, usable,
Hmm.
and it kind of tells you when that cycle's coming and when it's going, right? So
Yep.
it gives you the timing on it.
Hmm.
And yeah, I kind of wonder if that real estate cycle is going to trigger some debt issues.
Mhm.
Okay, some debt cycle stuff, which eventually trickles off into the S&P 500.
Mhm.
Maybe that's the story behind this next drawdown in like 2028, 2029. Maybe that's when you have a debt crunch, for example.
Sure.
So,
Sure.
yeah.
Or that's where, 29 rhymes with, 1929, and that could be that could be
Yeah.
interesting as well.
Yeah. The Niners. Yeah. Never good. Right.
Never
So,
good. Yeah, historically. So that's an interesting spin on it. That 26 is really just a short-term break, and then 29 we may get something ugly like we did 100 years ago. Not that we have to, but history does rhyme, as they say.
yeah. Yeah. It does. And the last 2 years have just been amazing, for a lot of growth managers.
Yep.
But I'm saying, hey, if you want to take some profits, table some cash, good time to do it. You
Yeah.
know, um, Interest rates are still relatively low, which means that 4% money market yields isn't all that tempting.
Mhm.
I started seeing a lot of clients cash out when money markets were at five and a half
Yeah.
percent,
Right.
but at 4.25, it's not that exciting.
It isn't, but compared to the 3-year number on bonds, it beats it by quite a bit. I mean, the aggregate bond is 3-year number is negative something. It's
Oh, the
below
three-year
positive.
historical returns. Yeah.
Yeah, yeah. So I mean, you're not making money on the safe money like you should be, like you normally would in an environment. So, I mean, for me, I look at cash and go, I could just hold
Mhm.
cash and be better than bonds for the most part.
Yeah,
Um,
no, right. Bonds have no excitement for me either.
no, it's fascinating, and I think a great observation that you made or you're making is that as an active manager, you don't have to be 100% invested like most mandates are, right? You can say, oh,
Correct.
this is a little sketchy. Let's go down to 80, 70, 50, whatever to soften the blow of that environment.
Yeah, and as a market timer,
Mhm.
I use market timing as a fixed income substitute.
Yeah.
Okay.
Nice.
And if you use market timing and you're out of the market 60% of the time, which is kind of the magic number for me, I'm in the market 40% on average and out of the market 60. If you're using an unleveraged S&P 500 index fund, you would have the volatility of a standard bond fund
Mhm.
going over the last 10 years,
Right.
but
That's
with much
amazing.
better returns,
Yeah. Yeah.
right?
Uh-huh.
And everyone's been looking for fixed income alternatives. And what I've created basically is a liquid alt to
Mhm.
bonds
Right.
for clients that get nervous about the stocks. And it's been working pretty good.
Yeah. No, that's fascinating. You come at this in a completely different way than really anybody else I've met. And that's one of my favorite things about talking to you about this stuff, because I love how you take the cycles and the seasonality and make this all into a almost like a calendar thing instead of a let's look at trend.
Oh, it is. It is. Yeah. So that's the fun part about the strategy is I started out as a market technician, looking at moving averages and
Right.
oscillators and all of that stuff. But by using a statistical approach, I'm able to put together a daily likelihood of success
Mhm.
for every day of the year up to 5 years in
Oh,
advance.
wow.
These signals still work. So
Right.
what I do is I really hustle that last week in December. Okay, that's when all the magic happens.
Sure.
And I put together a trading calendar for the next year, and I give it to my admin assists, and then I kind of walk away for a year,
Yeah.
right? And it's great. There's nothing like it.
That's amazing because you're not really influenced by the news, by clients panicking. It's just like this is what's going to happen. You don't really get influenced. I know sometimes being a trend follower in our time, you get a client going, "Oh no, Trump's going to do whatever right now, or Biden
I
was going to
know.
do something back then," and it kind of makes you go, "Oh, is something happening that I'm not seeing?" And it kind of messes with your psychology a little bit. I know I find that
Yeah.
I kind of have to
Oh,
separate
it
myself.
happens because people are very tuned into, the politics
Yeah, yeah,
of the thing.
sure,
Um, what I think the cycles do is they don't tell you what's going to happen,
right,
but they tell you how people are going to feel
hmm
about what happens. Okay.
right, right.
And we've had a lot of crazy things happen in the last few months, and the market really hasn't been all that concerned.
No, no,
Up to this point, people have been making money, hitting new highs. This is great. Um, but you've had some fairly significant shakeups happening and, business as we know it,
Yep.
and nothing's happened. But with the cycles turning,
Mhm.
I suspect that the markets will become more reactive, right?
Oh, for sure, for sure.
Yeah.
But again, you're not really influenced because you have the calendar written out ahead of time. So that's amazing.
Yeah, yeah, you kind of know what you're going to do, right? And that's a big advantage of, being a futurist and doing some of the technical work
Right.
is you have you have a method behind your madness, right?
Mhm.
You kind of know why you're trading, and that's really helpful.
Right. And you're also one of the first people that I saw use AI to help in this process. I know we were talking about it. I really didn't get as far as it as you did. I know we certainly talked about it years ago.
Hmm.
But it's just amazing that you were definitely on the leading edge of that technology as well.
Yeah, yeah, it was great. Yeah, I was using kind of a precursor to
Mhm.
generative AI called machine learning.
Mhm.
Um, and the technique I use is called a logistic regression,
Mhm.
which is also used by like Netflix, for example, to determine if you're going to like a movie or not, right?
Oh,
Or it's
nice.
used by drug companies to see if a drug's going to work or if it's going to fail in trials.
Mhm.
And it's a very cool technique to use for this or that kind of questions.
Yeah.
And the this or that is simply, is the market going to go up or is it going to go down,
Mhm.
right? And then you put together the factors that seem to matter, and I use a dozen factors or so in my model. And then the AI, logistic regression basically tells you how important those factors are in setting their weights to create a daily score. And that's kind of the guts of how it works.
Yeah.
Hmm.
No, that's just a fascinating process. Again, you always watching what you do is always feels like so cutting edge. So it's fascinating to watch. So well done.
Yeah, it works most of the time, but as I said, the last 3 years, if
Mhm.
you've been optimizing based on seasonal effects or
Right.
calendrical effects, didn't work out quite so much.
No, no, and we were talking about that before we got on here. So what do you think changed in the seasonality? Although it does, like we said earlier, it does seem to be coming back into play. It's
Yeah, it
very
does. It
very on
does.
again, but it has
Definitely.
not been certainly not last year.
No, no, not at all last year. And we were kind of saved by, our longer term cycles, which
Sure.
were risk on all year.
Mhm.
I think a lot of it was just federal intervention, and my learning out of that is that um, nothing matters so much as monetary policy, right? And
Yeah.
bad news is good news if bad news means lower interest rates, because that seems to be driving everything else right now.
Right. Right. No, great stuff. Great stuff. Well, also, I think we're just about at time. One last question. Of course, we have the name Uncommon Knowledge Conference coming up May 4th to 7th in Orange County, California, which is Los Angeles area.
Mhm.
I think you're going to be there.
Absolutely. Yeah. Mhm.
I will be there. Not going to miss it. Any highlights? Anything you're looking forward to doing while you're there?
Love it. It's just a great crowd of people that really think about what they're doing on the investment side. These are all active managers who are putting together their own strategies. I've learned a ton from you guys,
Mhm.
not only on
Vice
the
versa.
market side, but the practice management side and the marketing side. It's been just a great group to hang out with. Yeah,
No, absolutely. As you said, I've learned a ton from you specifically. So I appreciate you taking the time and always chatting with me. Just not even here, but outside of this, I
of
appreciate the
course.
time you give it. So
Yeah,
it's a very giving community who's very open
it is. Yeah.
versus some other communities which are like, oh, I have this top secret thing I can't tell you. It's like, who cares?
No,
We're not.
people are super honest. And
Yeah,
it's really cool to say,
it
I
is.
really shouldn't have done that. And people are very open about like
Yeah.
their wins and their losses too, and you can learn a lot from that.
Absolutely. And ultimately, we're not competitors. I don't feel like I'm a competitor to you in any way. So you knowing what I do or me knowing what you do doesn't really affect either of us at all. So
Yeah, yeah. But we can both get better. So yeah.
absolutely. No, that's the idea. So appreciate it. Well, thanks for being on today. Thanks for your time. I love your wisdom on the cycles. Keep up a good work, and we'll see you in Los Angeles in
Cool. We'll
a month or
do.
two.
Mhm.
All right. Thanks again.